Welcome to Massive Passive Cash Flow, the podcast that guides professionals to financial prosperity. Join our community and let's start building your wealth. Here's your host, Gary Wilson.
Welcome back to the Massive Passive Cash Flow podcast. I'm Gary Wilson, your host. I'm so glad to have you back listening and or watching the show. We have a great guest today, Mick Heyman, and it's got a great subject that applies to pretty much each of you. You know, whether you're a professional, you're a business owner, a real estate investor, stock investor, or any or all of the above, you need to really listen and pay attention. It doesn't have to be as stressful as you think it is when it comes to the world of finance. So just hang on to your seats and you'll find out how and why. So Mick, first of all, thank you so much for being here, man. I know we're lucky to have you, and I'm thrilled that you're doing this. So thank you so much for doing this,
And thank you, Gary. I'm excited to be on the program and really appreciate the opportunity.
You got it. Well, let's start at the beginning. I know most of us aren't doing what we set out to do when we were, in high school and maybe even college sometimes. But tell us about what led you to where you are now. What was the path you've taken to get to where you are? What led you to this?
It's kind of funny. I was in college, although I majored in economics. If you looked at my transcript, you'd say, "What did you do the worst at?" And it was econ. And I remember a statistics professor after the midterm leading me, so you got to come here. I know you don't know much about statistics, but let's look at the odds of you passing this class after this midterm. He said, go to the drop office, try it again next time. And so numbers and such were not my thing, but I did get an internship with an investment counseling company and realized pretty early on that numbers weren't the key, that it was emotions that really led me to it. And so my love of literature and psychology and philosophy kind of led me into the world of investments. And I just loved it. I loved the combination of helping people and then the interest of the markets and the fact that the future really isn't about numbers, and so that was kind of the fun I had early on with my career.
Yeah. It's funny you mentioned the fact that the emotions are really the key. This has come up a lot lately and not just podcast interviews, but, my own business affairs and people that I teach around the country is a lot of it is just keeping a cool head. I mean, markets go up, markets go down. There's microeconomics, there's macroeconomics. You don't have to be an expert at everything, but it's good to be informed and educated to understand how it all works so you can kind of follow the trends. But really the key is it always ends up being the same as long term. You want to think long term, and the people that do always do the best. And the people that seem to try to fight that thing day in and day out usually end up getting old quickly and wasting a lot of money.
Yeah, and time. I think of these shows that are on, 24 hours a day, and they're interviewing all these quote experts. And not that these people aren't smart, but at any point they're expected to predict something, and as all headlines do, they're there to scare you. And every day there's something that could potentially scare you into doing this or that. And most of the time being patient and the rules of investing and with your podcast and what I've listened, it's on the one hand not that complicated. What's hard is following it with your emotions. And if you just followed the rules, that's one thing. But all of a sudden the market goes down or interest rates go up with real estate and you're like, oh my gosh, and then you're doing something that probably you don't need to do.
Yeah. The surprises are what gets people. They think they have the perfect plan, then the market does something they didn't expect. So let's talk about that a little bit. I guess at some point in everyone's lives, we're going to have surprises. I guess one of the keys is, are you prepared? How are you? So can you touch on a little bit about, when it comes to managing their finances and their money, their wealth, their investments, and relative to what happens when something happens that you didn't expect, the inevitable surprises,
Well, and I think that's something that you kind of need to go into investing expecting. You don't know what the surprise might be. I remember one time this couple came in and they said, we're worried about, a crash like 1929. And this was back in the 80s. And I thought for a moment, I thought, the market's doing great. And this is not something to worry about. But then I thought, this is the question they're asking. So let's look at what would happen if we had a crash like 1929. And so I actually looked at, how much the market dropped and what interest rates did. And they had a diversified portfolio. And we looked at, well, you have X amount now, it's producing X amount of income. If the market dropped like it did in 1929, the income would be the same. And potentially, your assets might go down a bit, but would you be okay with this level of whatever it was? And they looked at it, they said, yeah, it would be fine. And we like the balance, we'd like the diversification. And if it went down, that would leave us some cash to actually invest. Well, ironically, and what I should have done is sell everything when they said that, because 2 weeks later, the 1987 crash happened and the market dropped 25% or 22% in one day. Well, you'd think they'd have been angry, but instead, when I called them up, they said, you already did the work. You showed us what would happen if the market dropped like this. And ironically, the portfolio was right where they said, they thought the income was the same, of course. And they said, let's buy some stocks. So the bad surprise happened. For me, totally unpredictable, but they had cash to actually do the right thing, as opposed to other people who took the shock, weren't expecting it, and were in the market selling after that happened because they were scared. And so that's the difference, is trying to realize there is a surprise out there. Of course, who predicted the pandemic and all the different things? And of course, we're all scared about our money. We're scared about toilet paper. We're scared about everything. But at least if you think these things are out there, you're a little less prone to panic. And that's where you make your worst decisions.
Yeah. It's interesting. Early in life, fortunately, I was in banking, so I learned some good material there. And it's funny because bankers look at money the opposite way of consumers. If you look at accounting, but I learned a lot. And my grandfather was successful. My father's family, family of business owners and so forth. So I learned to start early, and I learned to dollar cost average. I just would put in the same amount every paycheck, like religiously for years. And then always keep a little dry powder on the side, so we call it buying the dips. When you have a giant correction like that, boy, that's opportunity time.
Exactly.
Buy low, man, and hang and just hang on. The other thing I learned is, this is a really good lesson for everybody, and it applies to real estate, stocks, bonds, gold, silver, and if you're in crypto, that too, is don't ever use your capital, your principal, for other things. You can borrow against it to buy a house and buy a car and buy a boat, whatever. I used to do those things. Don't recommend them, because boats are really suck a lot of money out of your pocket. But
Exactly.
but the point is let it grow, let it grow, let it go, and let it grow. And the biggest mistakes the things I regret the most were not the things I bought, properties and stocks and bonds. It was the ones I sold. Because look at the stock market now. I just hit 40,000 for the first time a few weeks back. Look at real estate in the last couple of years. What's happened to prices there? When I did what I did, because it was, unfortunately, it was a divorce situation, and I thought, I'm just going to do whatever I can to get out of this whole mess. And so in one regard, it was the right thing to do. It bought me my freedom. But on the other hand, hey, if I'd have just kept half the properties, I could buy another big boat right now. I wouldn't do it, because I've learned my lesson on that too. But yeah,
No,
go ahead. I'm sorry.
No, I was going to say, I love your example too, because it is patience sometimes that is the best. And one of my first clients that I worked with, she hardly even knew what she had. She just cared, were we producing enough income? Now, in her case, it was stocks that were bought 30 or 40 years earlier. And so it was producing all the dividend income that she needed to live on. And she had like 80 or 90% in stocks that were, had we sold, the capital gains back in the 80s were so large, it would have, you'd only have done it if you had to. And so we didn't do much. And we used to joke, this is our strategy of benign neglect. And of course, we weren't neglecting her, but when you compared all the other portfolios that we were trading in and out and trying to time the market and do all these things, guess who at the end of the year most of the time did the best? It was Eloise, my client, who we did nothing for, just
Yeah.
patience. And imagine you sold Apple the first time it tripled, goes from 1 to 3, and now it's at 190 something.
Yeah.
Being patient, that doesn't mean take some profits along the way. Now it's easier to do with stocks than real estate, but still
Mhm.
that apartment you may have bought a long time ago is producing the income. You're raising rents every couple of years. That passive income is all you need. And by saying, well, it was 100,000, now it's 300, I better take that profit. You're forgetting that over a long period of time, that who knows what it grows to.
Yeah. Well, I tell you what that brings to mind it's the old classic risk versus reward equation. I tell people when I coach people, I kind of bring it in practical terms that they would understand. Like I'll say, we're going to compare upside potential with downside risk, and then the closer they are together, the maybe you wait and you don't do something right away. But if downside risk is really low and upside potential is really great, yeah, that's probably a move I would take. Now that's a generalization. We're not getting in any numbers or anything, but that helps them understand risk versus reward. So what?
Really
I mean,
agree.
do you have any advice for people who are they look at the news, which unfortunately is going to uh, dramatize things, animate things, and make it look. You don't even know what's real. So what do you tell people when it comes to determining real versus perceived risk, and how do you kind of manage that emotional part of it because it is.
Well, and I think what you're getting to is an important point. Is most of the time perceived risk comes from all the different fears and headlines that are out there that cause you to wake up at 3 o'clock in the morning and say, "Oh my God, what if this happens? What if that happens?" Whereas the better thing to do is analyze what is the real risk. What is, if the
Mhm.
market goes down another 10 or 20%, does that hurt you or not? And if it does, if you're stepping into, I was listening to one of your podcasts and the fellow was saying he had took a spec house at $3 million and he lost several $100,000 on that house. Well, that was a risk that, if he analyzed, would he have said, what happens if we have a bad surprise? And so if you can analyze what is the real risk of any investment you go into, the opposite there is what you've been saying, is if you,
Mhm.
in the stock side, if you dollar cost average and you just keep putting money in, you don't even know what to root for, do you? Every month
Yeah.
you're saying, am I happier if the market goes up or down because I'm buying? And so if you're a young person, you don't care if the market goes down as long
Right.
as you understand the risk of it. On the other hand, I'd also
Yeah.
say if you're a young person, make sure you have that emergency fund out there. Don't put
Yeah.
everything in because if your car breaks down or you lose your job, you want to have 6 months of income and such. So in every area of your financial life, analyze what the risk is and then try to stay away from the headlines because that's getting all the perceived, oh my God, if this, Putin does
Mhm.
this or so and so becomes president. In the long run, those things really don't matter. At least
Yeah.
and history proves that. One of my first assignments was going back, and I had to get a bunch of data from the 1920s and 30s. So every week I had to look
Mhm.
at what did Barron's say and what were the numbers, and of course I'm reading the headlines. And I'm telling you, every week, whether it was something big like the crash or something small like so and so becoming elected, every week it looked like the world was coming to an end. And what proved
Yeah.
to me was it didn't. And that's the kind of the attitude we need to have looking forward, that we need to protect ourselves from the real risk and the perceived ones. Try to go watch your podcast or go do something else. Don't pay attention to these news shows all the time.
Yeah. Did you know that you can participate in class every Monday? We call it Monday Night Live, 7 p.m. Eastern, with me and dozens of other investor agents from around the country, in fact, the world. Every Monday, totally free. No selling, no recruiting, just straight up education on anything and everything in real estate. And we have a lot of good guests coming on once or twice a month, bringing in expertise on subjects like how to buy a house with crypto. Okay. How about them apples? What about AI? How's AI affecting our business? How about the metaverse, blockchain processing? We're already using it in title work. So come on to Monday Night Live. Be ready to take notes and ask questions because it's live and engaging, and you get to participate by asking questions and meeting others. So we'll see you there. Go to GaryRealEstateWithGaryWilson.com. Click on the resource tab, drop down, and you'll see Monday Night Live. And in there, you can see one of the most recent classes. But more importantly, you can register for class as many as you want going up to like the end of the year, I believe. So in any case, do that. We'll see you on Monday Night Live. Look forward to meeting you in person. Take care. I know, and I always catch myself, and I wonder if one time they're gonna shut me down because I always say, hey, if you can't watch that mainstream media because, and I'll just paint the clear picture for people. That's now a commodity. Back when cable television came out and you went from having ABC, NBC, and CBS nightly news, it was pretty much a community service. It was an applied service that the networks did is to participate in the world of advertising and television shows. In fact, if you look at the world, they used to call them what program are you watching? Well, what's the programming say? It's programming. It's programming. They're trying to sell market space. And it became commoditized back in the late 80s and early 90s. And now you've got the big news. I'm not going to name them all, but you know who they are. They make money by having more people view. And the way they get more people to view is to get you excited emotionally, get you charged emotionally. They'll show you good things and bad things. Unfortunately, it's about 99.9% bad, is that fear is the biggest motivator there is. And they can sell advertising space for more money because they got more people watching their fear-based stuff. That's exactly what it is. Is there some news in there? Yeah, but it is. They're not giving you the truth, the whole truth, and nothing but the truth. They're taking little snippets, depending on their agenda, and that's why you see two opposite interpretations of the same news. So back to this now. One of the things that leads to is a famous little acronym called FOMO. Fear of missing out. FOMO. And I know I probably just gave a little explanation of how you avoid that, but we can't help it. Even if you're not watching the news, if you're watching the market on a regular basis, it can be dangerous, right? I mean, what can you tell people about trying to avoid that FOMO and make good decisions that are alignment with their objectives? How do you like sticking with the plan?
Yeah, I think it comes to there are two things that come to mind. One is know yourself. Know what kind of person you are, and then set objectives based on what's reasonable based on that. I give you a couple of examples, and one that I wrote in my book was when I was a little kid. You talked about your grandpa teaching you lessons. I used to listen to my uncle and my grandpa argue all the time. My grandpa was the typical, if he was playing golf, it was hit the middle of the fairway, play par bogey golf and don't mess up. Don't spray it into the woods, that type of thing. Where my uncle was the big hitter. He was the swinger. And so when they talked stocks, it was all about my grandpa saying, take a little profit here. Just do keep balanced in your portfolio. And my uncle going like, that's crazy. A stock is either a buy or a sell, and you let it run. And I don't care if it's 30% of my portfolio. I want to make some money here. And over time, my grandpa knew what he was like. He always took the profit. And he said, this is my objective, and this is who I am. I'm a middle of the road guy. I'm not a speculator. My uncle, on the other hand, was a big speculator, and amazingly, he did fantastic. Except when the tech debacle happened in the late 90s to early 2000s. And I remember him telling me, he said, oh my God, if I don't start selling, your aunt's going to divorce me. I've really let myself hang out there too far. And based on the panic that happened to him in the early 2000s, he learned a lesson. He could still take a lot of risk, But boy, when 2008 happened and the banks started falling apart, immediately he said, I got to cut my losses early because that's what I need to do to make sure that I can be as aggressive as I want to be. And so
Right.
he himself moved a little towards my grandpa's philosophy because he said, I want to keep speculating. I want to do that, but I also want to protect that part of the portfolio so, I don't lose my marriage and my house.
Yeah.
And so if you're a speculator, that's okay. That's not me. That wasn't my grandpa. But you can do it, but set the objective so you're sure that if things don't go well, you're not going to lose everything. And then if
Right.
you're the guy who's the middle of the fairway guy, accept that and say, this is my
Yeah.
objective. I'm okay with being the middle of the road guy. And there's an old expression in when I was in the institutional world. If you were always at 50%, if you were the middle
Hmm.
of, you were the second quartile in the middle 50% every year, after 5 or 10 years, you were in the top 10% because of
Yeah.
all the wiggling that's going on. And so if you're that, accept it because in the end
Yeah.
you're going to be successful.
Absolutely. Yeah. It's funny. Uh, I'm going to go back a little bit to my prior comment about the news, and of course, it's all politically charged now. Just everything is politically charged. How much should we pay attention to politics? And I mean, there's there's global politics, there's local politics. I mean, what's your take? I guess we do have to pay attention to some degree, but how much of that, how much should we pay attention to it, and then how should we pay attention to it when it comes to investing or investing decisions?
Yeah, I think have always been in the camp of minimize how much politics affects your investing because
Yeah.
it's so politically charged. It's hard to figure out. Decisions that are made sometimes really don't affect anything for years to come. And so
Hmm.
something that Obama may have done, Trump may have taken credit for, or even 8 years later, it may have been more Biden. And so things
Yeah.
that the politicians are taking credit for may have been as a result of the predecessor, both good or bad, by the way. I'm
Yeah.
not about being political here because as an investor, most of the time, keep your eye on the ball. And the ball is,
Right.
in my book, is not politics. Now, I'm not minimizing that part of our
Right.
lives. And for people who are very invested in one party or the other, fine. But what I'm not saying is let that affect your investments. People who said,
Yeah.
oh, if he gets elected, I'm going to sell everything. Generally, that's not been a good investment strategy.
Yeah. Yeah. I agree. And I think the things you really look out for are not necessarily the the politics or political news. I mean, you have to sort of know what's going on, but it's the policy. What type of legislation are they looking to put through, and what's their economic policy, and then you can vote. Hey, I think Keynesian economics is the way to go. And by the way, I personally don't believe that because I have studied economics, and I think that's can create a lot of problems. Well, like inflation, for example. But at the same time, if you look at classic market-driven economics, you know, at the outset, a couple of centuries ago, they didn't account for things that we have today, like the massive amount of technology and information we have available to us. We didn't have that 200 years ago. And then also you've had, capitalists that would take advantage of labor. And that doesn't really happen anymore. Well, I shouldn't say it. It happens in other parts of the country, but at least in America now, if you're not happy with your wages, just go get another job. There's plenty of jobs out there. But 100 years ago, 130 years ago, we needed to correct the imbalance there. But in any case, at the end of the day, you just have to decide which policy you're a fan of, and you go with that. Um,
I would
let's talk a
also,
little bit.
go
Oh,
ahead.
yeah, go ahead. Yeah.
I was just going to say, and the other thing to pay attention to is the long-term trend of what's happening. When I
Hmm.
got into business, talk about real estate, mortgage rates were about 15%,
Hmm.
and
Me
interest
too.
rates were that high, and inflation was like 14 or 15%. And if somebody would have said interest rates, that at some point you could get a 3% mortgage, I think they would have locked you up in an institution. There's no way, but interest rates and inflation started coming down. And that's been coming
Yeah.
down for up until recently for almost 40 years. But if you
Yeah.
look back, interest rates have been rising for about 30 years before that. And then, I mean, these trends are slow. It's like an ocean liner. And so we're
Yeah.
all excited about who's president or who's doing what. But sometimes it's better to step back and look at the long-term trend. And like you said, the stock markets and real estate have been fantastic. When I got involved in the stock market, people thought, you're better off being a garbage man or whatever. I mean, the
Yeah.
stocks were horrible after the 70s,
Yeah.
but that trend changed. And thankfully, I like to say my timing was right. It's more my birthday was right. So
All right. You remember, I guess they call it Black Monday. It was in October 87. I forget, I was at my first job and the market went down like something like 512 points. I mean, it was people
22% in a
people running on
day.
the office trying to
Yep.
get radios to turn on and stuff. It was nuts, So, I forget what the percentage drop was. It was pretty, I mean, back then. I think the stock market
22,
was like a
22%.
yeah. That's when you're referring to. Okay, that's amazing. And right before that, we had the Tax Reform Act of 1986, and that created for guys like me. I was a 85, college graduate, and it created opportunity for me
Right.
because it took away a lot of the loopholes for self-employed people. And guys like me just showed up at the right time and I had a little bit of money and got my first property. That property, I should have held that one. Boy, that was
Right.
$63,000 I bought it for. Now
Wow.
it's worth easily over 600,000. 4 bedroom, 2 bathroom ranch in Virginia Beach, Virginia. But again, at the time, hey, I got to sell this one and buy the next one for my wife and mine. But of course I learned better over the next few years by investing. So, but what I want to do now is talk about understand you have a book out, um, mellow your money, and would you mind touch on that? What are some of the categories or the key things here you cover? And I want people to get the book too, by the way, because I did read the I forget what you call that. It's an excerpt like on the back, and it was pretty awesome.
No, thank you. And really, what it is a summary of many of the experiences I had, some which we touched on in the show. Because in
Mhm.
my estimation, there are tons of textbooks, or if you could go online, there's plenty of lessons to learn. But if you haven't figured out the emotional part of investing, when time gets tough, you're gonna panic. At least that's what I did early on. And so what I wanted to
Yeah,
do is bring out some of my real experiences, both in life and in the market, that taught me lessons of how to approach markets. And so I did it
right.
through stories as opposed to through a textbook thing. And I thought that was kind of a fun way of approaching investing as opposed to, telling people absolutely what to do or not to do, because I always thought if you don't look at what can happen and the surprises or how to learn lessons. And that's the other thing is when things happen and you make a wrong move, learn a lesson from it, whether in life
Yeah.
or in the market. And so that's basis of the book. And I worked with someone that hopefully we brought a little humor and fun to it too, so that it's an easy read.
Yeah. Well, I appreciate that. I know we're getting close on time here, but is there anything you can think of that you'd like to tell people that we haven't gone over in the podcast so far? I mean, it could be famous words of wisdom from your dad or uncle or granddad, or it could just be something contemporary that you think, hey, Gary, we should really, point this out, give people something to look out for. Anything that you can think of?
I think the biggest thing I would say is that, we're all in this world trying to deal with all the things that are going on around us. And it's
Hmm.
and it's often tough in different ways. And so if we can really try to know ourselves and try to experience the world as a place to learn lessons and be patient and compassionate with those around us, we will grow. And I think in that growing, we're going to invest better. And so I guess my
Yeah.
biggest message is let's learn from the things that are happening to us and realize it's happening to all of us and be a little
Yeah.
compassionate in that way too.
Yeah. The other thing too is your calm demeanor will help calm other people down, you know. And so just remember that for the listeners out there, it's just you can kind of be the leader in your tribe, if you will, and be the calm presence and the voice of reason. Because if you look over history, whether it's real estate, stocks, they're always gone up and you've always gone down. When people ask me, hey, you think it's going to go down? I'm like, absolutely, it's going to go down.
Absolutely.
And if you think it's going to go up, I say, oh, definitely, it's going to go up.
Yep.
But hey, how do people get the book? Can they go to your website or just go to Amazon? What's the best way? What do you
Yeah, either
prefer?
way, Amazon, Barnes and Noble, both carry it. And then the website is www.mellowyourmoney.com. And I think somewhere in there you could get a free chapter to see if you like the way I write. So
Okay. Well, I'm pretty sure if you write the way you speak, it's going to be pretty awesome. I mean, I love that. It's like a stream of consciousness. You're bringing out real life stories, and that's what connects with people. I mean, it's just, I'm not trying to preach a sermon here, but that's why the Bible and the Quran and the Gita and the Torah all make sense to people because it's told in stories. And people remember the lessons that are embedded in good stories.
I
Um,
agree.
Yep. So guys, it's Mick, M-I-C-K, Mick Heyman. It's spelled Hayman. And again, the book is Mellow Your Money, and the website, mellowyourmoney.com. So thanks, Mick, for being here, and thank you for the listeners being on. We'd love to have your review. Or just go to whatever channel you're listening to. Apple's the biggest one, of course. Go there, leave a review. We certainly appreciate it when you do that. And in the meantime, God bless you and your families. And we will see you on the next Massive Passive Cash Flow podcast.
Thanks for listening to this episode of Massive Passive Cash Flow. Be sure to go to realestatewithgarywilson.com to join our community and start building wealth today.